Welcome to the Deep Dive. We've got the details here on TopBuild Corporation's Q3 2025 performance, which they reported back on November 4th.
Yeah, and our mission today really is to unpack what happened because honestly, this earnings call was a bit confusing at first glance.
It really was a confusing picture.
It was, yeah. Almost a masterclass in that gap between market psychology and, actual execution. Because if you just looked at the headlines,
right?
TopBuild delivered beats, both top and bottom line. Adjusted EPS came in at $5.36. That was comfortably ahead of what analysts expected.
And revenue too, right?
Revenue too. Hit $1.393 billion. Consensus was around $1.38 billion, so another beat there.
Okay, so financially, they hit their numbers, check the boxes. But here's the big question, the one that jumped out immediately. Why did the stock tank?
Exactly.
Two market indications had it down, almost 3%? And then mid-session, it hit a trough, down 6.6%. That just feels brutal for a company that beat consensus and raised its full-year guidance.
That's the paradox, isn't it? And
yeah.
That's what we need to sort of solve for you right now. The market wasn't worried about the total number itself.
Mm-hmm.
It was worried about the ingredients, how they got to that number. And short answer, it's this battle between pretty severe volume weakness in the core business versus really powerful, almost aggressive M&A contributions, acquisitions. So the market saw disciplined financial results, sure, but maybe not so much organic health.
Exactly. That makes sense. So we need to go beyond just the raw numbers. We need to dig into this M&A strategy, which seems like it's fundamentally changing who TopBuild even is as a company.
Absolutely.
And then look really closely at how they're managing to defend these, really high margins when the industry's facing some pretty serious headwinds.
Right.
Okay, let's start with those raw numbers then. Just lay them out. $5.36 in adjusted EPS. $1.393 billion in revenue. That sounds decent. It's 1.4% year-over-year growth.
Yep. And adjusted EBITDA looks strong too. $275.6 million.
Yeah.
That translates to a, pretty resilient 19.8% margin.
Okay, solid numbers on the surface.
They are solid, yes.
Yeah.
But the moment you pop the hood on that 1.4% revenue growth figure, you see exactly why the stock reacted the way it did. The drivers were just wildly unbalanced.
How so?
Well, acquisitions, the M&A part, contributed a massive 7.9% growth. Huge chunk.
Wow, okay.
Pricing was pretty negligible, added just 0.3%, barely moved the needle.
Right.
But the core organic business volume that it fell by a pretty significant 6.7% year over year.
Oof. Yeah, a 6.7% volume drop. That's the kind of number that definitely makes analysts nervous, even if, it's masked overall by good deals they made.
It absolutely is.
It suggests, if that acquisition pipeline slows down even for a quarter, they could be looking at a pretty big revenue contraction risk.
Precisely. That initial market anxiety, it really reflected those deep concerns about their exposure to the residential cycle. Sure. TopBuild is facing real pressure there, no doubt. Now, interestingly, despite this nervousness in the market, management showed, absolute confidence, I'd say, in their financial position. They were aggressively returning capital.
How much did they spend?
They spent $65.5 million buying back shares in Q3. That was 177,983 shares. And they still have a ton of authorization left, like $770.9 million remaining under the current plan.
So management's effectively saying, we think our stock is cheap, while the market's saying, we're not so sure this volume weakness is going away anytime soon.
That's the classic tension, isn't it? Short-term anxiety versus that longer-term strategic transformation story.
Yeah.
And that transformation, that's really what we need to focus on next.
Right, the M&A.
It brings us straight to that strategic shift, because this isn't just about, rolling up a few small installation companies anymore. This feels more like a strategic mix upgrade.
What do you mean by mix upgrade?
They're actively moving away from being seen just as a company tied, heavily to housing starts. They're pushing towards becoming a more diversified commercial and industrial platform, a different kind of business, really.
And the scale of this move is pretty striking. You mentioned the contribution to Q3 revenue, but the total announced deals, it's huge.
It is. They either close or announce deals that in total represent about $1.2 billion in annual revenue capacity.
$1 billion. Yeah, that's definitely a fundamental recalibration of the business mix.
Absolutely. And the two big ones, the headliners, they are genuinely transformative.
Sure.
First, there's Progressive Roofing. They acquired that in Q3. It actually contributed about $92 million to sales just in Q3 alone.
Okay.
And this deal is pivotal. It establishes a whole new platform for them in commercial roofing, which is a high-growth area. Management specifically called out that this market is fragmented, and it represents a huge $75 billion total addressable market.
$75 billion. Wow. So a new platform, massive market, and importantly, less tied to the housing cycle swings?
Exactly. Less cyclical exposure. And then the second major deal is the SPI transaction. That one just closed in October.
What's their focus?
SPI is focused on really specialized areas, mechanical insulation, and custom fabrication work. This significantly extends their reach into the industrial customer base. It's a major play for that high margin, often stickier CNI segment, commercial and industrial.
Yeah.
They're basically betting heavily that they can use their operational know-how to integrate SPI quickly and effectively.
And speaking of integration, they weren't just making vague promises about synergies, were they? They put numbers on it.
They did. Hard numbers. They're targeting $35 million to $40 million in annual run rate synergies just from the SPI deal. And that's expected over the next 2 years.
Okay, 35 to 40 million. That's a crucial figure, right? Because it's a direct, quantifiable offset to potential weakness elsewhere in the business.
Absolutely critical number to watch.
They also did some smaller deals too, right? Tuck-ins.
Yep, several smaller strategic tuck-in acquisitions added roughly $50 million more in annual revenue. And I thought the Diamond Door Products deal was interesting.
What do they do?
They assemble and fabricate insulated steel door systems. Management made a point of stressing this isn't manufacturing, it's assembly and fabrication.
Oh, okay.
Which allows them to bundle those door systems with their existing metal building insulation sales. It's a smart adjacency play.
Yeah, capture more of the spend on those kinds of projects.
Exactly. Capture a greater share wallet. So given all this M&A activity, it's really no surprise they raised the 2025 outlook. Sales now projected between $5.35 billion and $5.45 billion. Adjusted EBITDA $1.01 billion to $1.06 billion.
Right.
This whole strategy is pushing towards that longer-term goal they mentioned, expanding their total addressable market to around $90 billion.
Okay, so the numbers show the transformation is definitely happening. It's very real, but, transformation costs money, and they just took their leverage up pretty significantly to fund all this M&A. It's at 2.4 times net debt to EBITDA now. Isn't that a bit risky? Especially if this residential slowdown sticks around longer than, say, the first half of 2026? Are they overreaching here?
Well, that's the real friction point, isn't it? That's what the market reacted to, I think. That 2.4x leverage is above their stated long-term target, which is usually 1x to 2x.
Right.
Management says they're comfortable. They point to very strong free cash flow over $791 million in the last 12 months. But the market sees it differently, or at least more cautiously. They're clearly prioritizing this massive growth spurt and strategic repositioning, betting bid on that C&I market over keeping the balance sheet super flexible right this second.
So taking on debt for growth.
Exactly. That confidence comes at the cost of higher debt, which is precisely why that initial market pushback was so sharp, I think.
Okay, that makes sense. Let's pivot then to the actual operating environment, because this is where we start to see the payoff from some of those tough cost decisions they made earlier in the year.
Right.
Installation services volume. It was down 10.4%. That's a steep drop. Only offset because M&A added 11% growth.
A huge drop, yeah.
Yet, despite that deep volume crunch, the installation segment's adjusted EBITDA margin actually improved. It went up 20 basis points, hitting 22.5%.
That improvement is genuinely impressive. It really is. And it's a powerful testament to their operational discipline.
How'd they manage that?
Management confirmed it. The key driver was that $35 million in annualized cost savings they implemented earlier. Things like facility consolidation, headcount reductions.
The actions they took before.
Exactly. Those operational moves acted like a shield, basically, protecting their profitability from the price pressures that were definitely hitting residential products like fiberglass and spray foam.
Okay, so installation is managing costs brilliantly, but did that same operational magic work for the distribution side of the business?
Well, no. Not quite to the same extent, and this really highlights the different competitive dynamics at play. Specialty distribution actually saw its margins soften. They came in at 16.9%, which was down 150 basis points year over year.
Quite a contrast. Why the difference?
It really boils down to pricing power, I think. The price pressure on those same residential products, the fiberglass, the spray foam, it was just significantly stronger on the distribution side.
Okay.
Distributors generally face more inventory competition, maybe have less ability to dictate pricing compared to the installation segment, where, as we saw, those disciplined cost cuts could protect profits even if selling prices were falling.
Got it. But the segment wasn't a total disaster, was it? Product mix helped out.
That's right. Yeah, the margin pressure was partially offset. They saw strong positive pricing momentum in their commercial products.
Yeah.
Especially things like mechanical insulation and gutters.
Ah, the CNI effect again.
Exactly. Which, again, just highlights why this strategic shift towards CNI, the commercial and industrial markets, is so vital for them right now. It's propping things up.
So looking ahead then, what did management say about the macro outlook? Does it back up this M&A focus?
It really does.
Yeah.
They gave a pretty clear view. They still see weakness in single-family residential.
Yeah.
They're projecting maybe flat to slightly down performance there in the first half of 2026.
Okay, continued weakness.
But interestingly, they did point to multifamily backlogs starting to look a bit better in certain markets, maybe some stabilization there eventually.
And commercial?
And commercial and industrial CNI. That's the undisputed bright spot.
Yeah.
Backlogs are building, they said, particularly in areas like data centers and commercial roofing.
Which plays right into the Progressive deal.
Directly validates that massive Progressive roofing deal. So, yeah, management feels very positive about CNI growth continuing well into 2026, which, reinforces why taking on that leverage to buy growth outside the weaker residential cycle might have been necessary from their perspective.
Right. So the big picture synthesis here seems pretty clear. TopBuild is navigating this tricky residential environment, doing it expertly in some ways, by leaning really aggressively into these higher margin commercial and industrial markets through M&A.
Yeah.
This proactive diversification, backed up by the operational execution we saw, especially in installation margins, that seems to be the main story, the story the market will eventually have to grapple with.
I agree. So what should you, the listener, be watching for now? Well, near-term catalysts really center on integration success.
Right. Can they deliver on those synergies?
Exactly. We need updates on that synergy capture from SPI and Progressive. And critically, watch the cadence of new commercial project awards. That's what will validate the investment thesis in this expanded total addressable market they keep talking about.
And don't forget, they have that Investor Day coming up on December 9th.
Oh, right. Good point.
That's where they plan to really lay out the details of this new $90 billion TAM strategy and also their digital roadmap. That event feels like the next major inflection point for how the market perceives the company's long-term structure.
Definitely one to watch.
Okay. Now, it is time for our signature segment. This is not financial advice. We take all the data we've just dug into and pitch an outrageous but plausible trade idea based strictly on the earnings material presented.
All right. So based on that immediate market reaction we discussed, the stock got punished pretty hard. And it seems like it was punished mostly because of that visible, quantifiable 6.7% volume weakness.
The backward-looking number.
Exactly. While maybe ignoring or at least heavily discounting the future, also quantifiable, EBIT's lift coming from those deals and those internal cost savings. The punishment was based on recent history, not necessarily the projected future.
Okay, so what's the play here? What's the trade idea?
Well, the trade is what you might call a synergy long. Basically, you're betting that those stated $35 million to $40 million in SPI synergies, plus the successful integration of Progressive Roofing, that all that will flow through to the bottom line faster and more reliably than the residential market continues to deteriorate. Now, the outrageous part is trying to perfectly time that synergy capture. That's always tricky, inherently volatile.
Sure.
But the plausible part is betting on the operational credibility they've shown. The credibility we just talked about. Remember, that team already drove a 22.5% installation margin using cost cuts, even when volumes were getting hammered.
Right, they proved they could execute under pressure.
Exactly. That execution track record supports the idea that they can successfully pull off the synergy capture on these new, bigger deals. And if they do, well, maybe the stock looks pretty cheap right now based on that future potential.
That distinction is interesting. Betting on execution, which they've demonstrated, over predicting the macro environment, which is much harder.
That's the core of it.
And it leaves us with our final provocative thought for you to consider. If TopBuild actually succeeds in transitioning its market perception, if people stop thinking of them purely as a housing cyclical company and start seeing them as a diversified industrial platform with this resilient CNI exposure, how much higher is the ceiling for this stock than today's somewhat negative market reaction suggests? Especially considering they just proved they can actually raise margins even while volumes are falling significantly, something to think about.